Hello and welcome to this session. This is Professor Farhat. In this session, we would look at management responsibilities when it comes to a SOC 1 engagement. Now, to be more specific, it's the management responsibilities of the service organization. What is the service organization? The service organization is the organization that provides services to the user entity. What is the user entity? Think of Farhat Lectures. My company is the user entity. I need to outsource my payroll. Best Payroll Services is the service organization. Now, at the service organization, what are the management responsibilities when we are involved in a SOC 1 engagement? So I'm preparing for a SOC engagement, a service auditor. The service auditor is the auditor of the service company. The service auditor must establish a clear understanding with the management of the service organization, Best Payroll Services, about their respective responsibilities. This agreement sets the audit scope and expectation and is influenced by management decision. Remember, management is deciding about the areas to be audited and the depth of the examination. Simply put, Best Service Companies, which is a service organization, is hiring the auditor. They have to have a clear understanding. They have to establish open communication with the right people. The people has to be knowledgeable in the organization. Therefore, they are helpful. If they're not knowledgeable, they cannot be helpful. And this is to make sure that the auditor can access accurate information. Who knows about accurate information? Knowledgeable people. Making the audit effective. It means they get to what they need to get to, and efficient in providing insight into the organization's operation and compliance. Simply put, making it easy for the auditor to do their job. What I'm going to do now, I'm going to talk about management responsibilities when it comes to this type of audit, SOC 1, and I'm going to be always mentioning MR. MR is management responsibility to keep you on track, because there's going to be a list of things. So I'm just going to keep reminding you this is management responsibilities. These are management responsibilities. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
First thing the management has to do is need to identify which services, transaction, business unit, or application are relevant to the internal control over financial reporting that will be audited. So simply put, we are looking at a SOC 1 engagement because we are dealing with internal control over financial reporting. And by defining the scope, this helps focus the audit on areas that are significant to the user entities relying on the report. Consideration should be given to contractual commitment require the provision of either a type 1 or a type 2 report to user entity. Of course, if there's a type 1 versus type 2 in a type 2, we have to test the control effectiveness. And this includes determining how often these reports should be issued and the specific period they will cover. Of course, that will be defined in the scope. Now, for an ongoing engagement, prior reports can be used to help define the current engagement scope. So if this is a repeating engagement, an ongoing engagement, you can look at the prior report to help define the scope of the engagement. Also, management select the report type. Management must decide whether they are looking for a type 1 or a type 2. They're simply hiring the auditor. Remember, type 1, assess the design of the control at a specific point in time. Type 2, report evaluate the effectiveness of these control over a period of time. And I hope by this time you know this. Also, when it comes to subservice organization, management will have to identify if any services provided by other entities are relevant to the internal control over financial reporting. So this is the service organization. This service organization, they use Best Cloud Services to help them operate their business. So simply put, Best Cloud Services is a vendor and provides services to Best Payroll. Now, Best Payroll Services will have to determine whether Best Cloud Services, which is the vendor, is a subservice organization. And we talked about subservice organization. Decides how these subservice organization will be included in the report, whether by the carve-out method, which is excluding specific subservices, or the inclusive method, including all relevant subservices. And we talked about both the carve-out and the inclusive method in a separate recording. Also, management will have to prepare a comprehensive description, and we had a separate recording about the description of the system, ensuring it's complete, accurate, and properly reported. Also, management makes certain assertions, develop a reasonable basis for the assertion regarding the design and operational effectiveness of the control. They make these assertions, the auditor will test these assertions. Choose and decide the criteria used in these assertions, ensuring they are suitable for their intended purposes. For example, about internal control, they use the COSO framework. State the control objectives, noting that any are mandated by law, regulation, or specified by external parties. Identify potential risks to these objectives and establish control that are designed and functioning effectively to mitigate those risks. And prepare a written assertion to accompany the system description provided to user entity. Simply put, management make assertions. Also, they have to support the audit process. They have to provide, they means management, will have to provide the auditor with access to all necessary information such as records, documentation, agreements, and reports. And this includes responding to additional information as the auditor requests them throughout the audit. At the audit conclusion, provide written representation, and would look at written representation letter to the auditor confirming the provided information and assertions. Also, if the service organization do have an internal auditor, if the internal auditor are used to assist the service auditor, ensure that they can follow the services auditor's instruction without interference from the service organization. So simply put, you don't want the service organization to be involved in this process. Also, management will have to make certain disclosure. So during a SOC 1 engagement, it's crucial for management of the service organization to fully disclose certain type of information to the service auditor. The disclosure is vital for ensuring the accuracy and integrity of the audit. So what type of disclosures they need to make? Simply put, just tells us stuff about things that happened in the past. Non-compliance and any misstatement. Management should report any known instances of non-compliance with laws and regulation, any detected fraud, or any incorrect misstatement that are significant enough to affect one or more users' entity. Also, it's important to confirm whether these incidents has been addressed, has been properly communicated to the affected user entity as well as addressed. Also, the management will have to disclose any intentional act affecting the system presentation. Simply put, you cannot mislead any known or suspected intentional act that could negatively impact how the service organization system is presented or affect the completeness or achievement of the stated control objective must be disclosed. And this includes any action that could mislead the users of the report or distort the audit findings. So you cannot simply mislead the auditor. Other disclosures would include control design deficiencies. Management must inform the auditor of any known deficiencies in the design of the control, and this could include weaknesses that could prevent the controls from effectively achieving their intended objectives. Operational failures of the control, it's necessary to disclose any instances where controls did not operate as described in the system documentation. That's relevant. Helps the auditor. This helps the auditor assess whether the described control are reliable and functioning as expected throughout the audit period. Also, if there's any significant subsequent event, any significant event that occurred after the period covered by the system description but before the date of the auditor's report should be disclosed. And these events must be evaluated to determine if they could significantly impact management assertion about the system. So what we did is we went through a list of laundry that most of it common sense in a sense that you would expect management to be helpful, to provide as much information, to provide disclosure about the company. So let's take a look at this multiple choice from farhatlectures.com. During a SOC 1 engagement, the management of the service organization must define the scope of the audit. Which of the following would be considered appropriate for inclusion in defining the audit scope? Now, when we're talking about SOC 1 engagement, always assume internal control over financial reporting. Evaluation of the market competitive and pricing strategy. Would that be part of the audit scope for a SOC 1 engagement? Is this what a SOC 1 engagement about? No, SOC 1 engagement is about internal control over financial reporting. A is out. Determination of the services relevant to internal control over financial reporting. Would this be part of the scope? I would say internal control over financial reporting, yes. Between A and B, I can definitely take out A, keep B. Analysis of future business strategies and potential merger. Is this part of SOC engagement? No, this is part of business planning. Assessment of the organization, cultural and ethical climate. Well, that's important, but this has nothing to do with SOC 1 engagement. So that's out as well. Now you might be saying, yes, assessment of the organization, cultural and ethical climate is important in the control environment where we discuss the tone at the top. Yes, but really what you want a more comprehensive answer: internal control over financial reporting, determination of the services relevant, because here they're asking us the scope. The scope of the audit is not cultural and ethical climate. It could be a small part of it, but the scope is about services relevant to internal control over financial reporting. And I gave you this question on purpose. I just want to keep reminding you that SOC 1 is internal control over financial reporting. SOC 2 deals with trust services criteria. I want you to know this inside out because that's going to help you tremendously for the CPA exam, as many questions revolves around your understanding about the difference between SOC 1, SOC 2, SOC 1 Type 1, Type 2, SOC 2, Type 1, Type 2. What should you do? Now you're going to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you're studying for the CPA exam or some other professional certification or accounting courses. Invest in yourself. Good luck. Study hard, and of course, stay safe.